Welcome to the Facts versus Feelings podcast. I'm your host, Ryan Detrick, and I'm joined by my co-host, Sonu Varghese.
Cutting through the noise each week with Ryan Detrick, Chief Market Strategist, and Sonu Varghese, VP Global Macro Strategist, taking out the boring and helping investors focus on what really matters. A quick note before we start the show. Investment advisory services offered through CWM LLC, an SEC registered investment advisor. Carson Partners, a division of CWM LLC, is a nationwide partnership of advisors.
And we are back, episode 166 of Carson's Facts versus Feelings. By popular demand, Sonu, on the YouTube channel, I have my Slayer shirt.
Nice.
See, it's like Santa Claus, Slayer, for the play
That's
on,
great.
I guess, a play on the rock band Slayer, the metal band Slayer, whatever you call it. I wore this last year. I was looking for some stuff to wear. This was so cold. It is just so cold in Ohio right now.
It's 10 degrees here in Chicago.
Yeah, it's something like that here. And I was looking for stuff for the morning call that you and I did this morning with our amazing Carson partners. I saw my Slayer. So I won't wear that technically for the morning call. Well, they could have. But I know this, we're recording this a tad early. So this is kind of the holiday season. And we did pre-record next week's. We're not going to give it away. We had a really special guest, recorded it last week. It's really, really good. And like I said, all I'll say is Boston. That's the only hint you get is Boston. But we had a guest. It was awesome. All right. So what do we want to talk about, Sonu? The weather,
you're expecting
your
any
kids?
gifts?
Yeah, I think we're expecting gifts. My wife keeps telling me she has to buy some presents. I'm like, yeah,
Okay.
let's go ahead and do that. It's probably that time of year to do that. So there's a lot of gifts. I guess Jerome Powell came bearing gifts, which is what we're going to talk about. This title of this one, The Fed Comes Bearing Gifts. There's lots to dive in. But first things first, you said you have some screaming kids upstairs. If we hear any screaming and yelling, we know what it is. Is that what just disclosure time?
Like 6 hours from when we are recording, not 6 hours, 5.5 hours. I have to catch a flight to India and see my parents and all that. But, I'm just going by myself. And as it turns out, today's the day both kids end up sick. Right, just before I take off, and I'm already feeling a little guilty about leaving the wife alone with my
you were just out of the country.
Like all of us together. Yeah.
Okay, you were together at least.
Yes. This time I'm going by myself, and now they're sick. Then I have technical issues with my computer, and it's all happening today. And hopefully we can do this in one piece. Come out smiling.
Well,
I'll be ready to go.
Hey, we'll give it the old college try. Well, safe travels, and again, happy holidays, everybody out there. It's that time of year. So, let's start, I guess, with one theme that we're seeing: AI. Right, AI. Okay. So last week, the S&P 500 was down slightly. The NASDAQ was down well over 1%, but the Dow was up over 1%. So that's the high level.
Yeah, the Dow was up 1.1%. The NASDAQ was down 1.6%.
So we've got this kind of dichotomy with going on, but I do want to point two things out here. On Thursday of last week, Oracle had earnings. They were pretty good, but honestly, not good enough for the market because Oracle was down 10%. Then the next day on Friday, Broadcom was down 11%. On some news. We don't need to get into the weeds of it. Just if you would have told me those two high-flying names would be down like that, I would have probably assumed the market would have been down a lot more. Yet, if you look at it, various sectors are really strong, specifically the cyclical areas. Once you dive into that, what's going on out there with the AI trade and then the whole market in general?
I think people may be like, first of all, I think a lot of people are concentrated. Right. And then you're expecting the moon. And when you don't get the moon, you're like, there's a problem here. Right. I think that's partly what's happening. And we're seeing this bifurcation. Yes. Right. Over the last month, maybe 40 days.
That was the word I was looking for earlier. Bifurcation. That's a much better word than whatever I said. Yeah.
So I just got thrown off. No. Anyway, 40 days ago, I think over the last 2 months, let's call it 1 to 2 months, Alphabet's been taken off. The start of the year, it was OpenAI and NVIDIA, and all of us were drawing those circular charts. And you remember that. We talked about that over here too. And now it's like OpenAI seems to be like literally show me the money, right? Or show a little bit like, hey, is this thing for real? And people, it's not like AI has gone away. I don't think it's easy to look at it and think that, maybe sentiment is falling off that AI train. I don't think it is that. I think it's just switching. It's switching from that OpenAI, NVIDIA, Oracle side of things. Maybe Microsoft's in there. Microsoft sort of been flat over the last 4 or 5 months to the Alphabet side. suddenly Sergey Brin is in the news, and it's like all of these things happen together, right? Like I suddenly see a whole bunch of new profiles on Sergey Brin, and I don't know what he's doing. Maybe he's very involved over at Alphabet. He's come out of retirement. He came out of retirement a few years ago. He's coding and all of that. But yeah, there's that vibe, right? Oh yeah, the momentum is with Alphabet right now as opposed to OpenAI. So that switch is what's happening. Now, Broadcom is, I think, on that Alphabet side of things as well. So, but we'll see. I think last week was a good example of why you should be diversified.
No, well said there. On Thursday last week, the S&P 500 hit all-time high, 37th all-time high of the year. Small caps all-time high, micro caps all-time high, mid caps all-time high, S&P 500 equal weight all-time high, and even the transports soared to new all-time highs. So this is a pretty broad-based rally. But I do want to point out something. It caught my attention. On the YouTube channel now, we'll share the Time Person of the Year, Drew. So we can put the Time Person of the Year up. It's the architects of AI.
Okay.
And it's the famous image from New York City. Everybody sitting up on the beams building. I assume it's the Empire State Building. Honestly, I'm not sure, but it's the old famous image. We've got Zuck on there.
They're having lunch or something, right?
Lunch up there. Yeah, just hanging out, talking about AI. We have Zuck on there. We have Sue from AMD on there. We have Musk on there. We have Jensen on there. Altman's on there. The CEOs of Google, DeepMind, and Anthropic are on there. And then Lai, I believe is how you pronounce it, of Stanford AI. So the true titans of AI are on the magazine cover. The inner trader in me says, oh my goodness, here we go. we talk about how great they are. And I kind of remember 1999, internet's going crazy. Jeff Bezos, man of the year. Well, that was, the internet worked, and still Amazon was an incredible company, but that gets me. Also, Jensen was named the Financial Times Person of the Year last week as well. Jensen was on Rogan a week or two ago talking about how great everything is. I mean, it's always obvious after the fact.
Sure.
I guess I'll just put it this way. I'm okay being equal weight tech in general. Maybe even some of these AI names after the beatdown that they've had. But I still think this is why you want to have a diversified portfolio. Because we might look back in a year and say, well, duh, didn't you see the Time Person of the Year? Of course, those stocks.
There'll be a lot of people there.
Right. The contrarian indicator, of course, those stocks are probably going to struggle. As a long-suffering Bengal fan, I mean, it's just terrible. We're horrific. Literally, first time Joe Burrow's ever lost in December. We got shut out last week. I'll just leave it there. But I still remember the Super Bowl, which we were robbed. There was a holding call in the end zone. Not that I forget that still cost us that game. But Logan Wilson, you can look it up. We were robbed. But nonetheless, every commercial, this was in February 2022, like every commercial was about crypto. Crypto this, crypto that, crypto this, only the bold, what's his name? Oh my goodness, I'm drawing blanks.
You talk about the strategy guy, or
he was the guy in The Martian. I don't know. It'll come. I've got his face right there. He's literally one of the biggest. He's talking about only the bold survive, or only the bold make money with stuff, and all these cryptos just crashed after that. It's like so obvious after Matt Damon. There it is.
Matt Damon.
It was driving me crazy. Like, who is the guy? Matt Damon's talking about how great crypto is, and all the cryptos crash afterward. That was an obvious one. I don't think we're in that scenario. I'll be very clear. But it does catch my attention, Sonu, when I see things like this, and now you've got some weakness in the AI trade. Where do you want to take this conversation?
Well, just last week, going back to what happened in markets, the S&P 500 is down just over 0.5%.
Okay.
Materials up close to 2.5%. Financials up close to 2.5%. Industrials, by the way, have crept up to be the third best performing sector year to date, with a 20% plus return. Maybe different, by the time you all listen to this, but it was up 1.5% last week. So the top three sectors are all cyclicals. Consumer staples are in there too, but and the other thing I think that's happening is a global recovery, right? You think about materials, and to some extent industrials too. A good chunk of their revenues come from outside the United States, right? That's positive. And speaking of overseas returns, the MSCI EFA index, that was up just under 1% last week.
Wow.
Total return of 30% this year. 30%. EM was up just under 0.5%. Total return of close to 33% this year, right? So, I mean, we've talked about the global bull market, but that's continuing in strength despite what looks to be, who knows, right? A vibe shift, if that's what it is, within AI.
And you know what Europe doesn't have a lot of is technology, and there are
Yeah.
some. I mean, there are some, but
Yeah.
they have a lot of financials, industrials, materials, and that's again what we're seeing. You know, one more thing from me, Sonu, then feel free and jump in. If we look at market breadth, I've talked about this quite often, but the New York Stock Exchange an all-time high last Thursday. The New York Stock Exchange advanced decline line, so cumulative basis, how many stocks went up versus down, also hit an all-time high last Thursday. Go back in history and look, everyone. You tend to see breadth lead price. You tend to see breadth peak well before price. There's a famous example in like early 98. Breadth, advanced decline lines peaked. Market kept going up for years, right? But it was weak under the surface, weak underpinnings because only tech was the thing going up at the end. We've seen this throughout history. Yes, February 2020. There was a new all-time high in advanced decline lines. And then the 100-year pandemic came. That's the one time this didn't work. But normally, breadth will peak maybe, say, 6 to 12 months before price does. And I think another new clock just started on this bull market with breadth justifying where we are, Sonu. What else you want to talk about from an equity markets or tech point of view before we dive into, I know your favorite thing, the Fed?
Yeah. Well, all 11 sectors are in the green here today.
Yeah.
All 11 sectors. I mean, the worst performing sector, I'm looking at my dashboard here, is real estate, which is interesting because the Fed is cutting. We're going to talk about that, right? That real estate hasn't perked back up, but that gets to, there are pockets of the economy that aren't doing well. Housing comes to mind and, real estate right there, right? Utilities have pulled back a little bit, 15.5%. But I want to go back to the international, ask you a question. Usually when people get excited about international, maybe this is true over the last 20 years, it's always like, oh yeah, I'm going to be overweight EM.
Yeah.
Now we've taken a different tack here. I don't know if that's a word, but maybe we've taken a different track. And they say, no, we're overweight developed markets. And nobody's ever excited about developed markets. Maybe once in a while you get some person out there. I was going to say a particular word that'll be offensive, like some guy out there like, oh, I like Japanese small caps or something like that.
Okay.
But set that aside. But nobody's like, everyone dumps on Europe, right? Nobody likes Europe. Everyone loves traveling to Europe.
Absolutely.
Nobody is like excited about Europe, and I feel like we're one of the few people who are actually overweight Europe. What's your take on like sentiment and maybe the contrarian piece that nobody's ever excited about Europe? You mentioned.
Well, first things first, I'm dying to know whatever you were about to say that was somewhat controversial to get you in trouble. Tell me off the record here. I can't wait to hear.
It's probably very benign, but I just want to be careful.
We don't want to get in trouble. I hear you there. I am wearing a Slayer shirt though on the podcast, although it's Santa Claus Slayer.
There you go.
So I love what you're saying. There is that contrarian in me. Now listen, I've done this for a while. You've done this for a while. I've seen pockets of this where people say, oh, maybe dip your toe in developed international or dip your toe in emerging market. And then for like a year, you see it.
Nothing happens.
and then, like, I think 2017 was a recent-ish year where strong global bull market, a lot of other areas did well, not just U.S. And everyone said, oh, keep your diversified portfolio. Maybe, maybe us in a past life would have said something similar. And then, no, you should have just been, all in on U.S. large cap. I mean, it is what it is. But I hate to say this time is different for most dangerous words. I think there's some stuff going on here, though, and you were all over it, right? Some of the fiscal policy and things that Germany was putting in play and different things. And honestly, some of it because of President Trump, some of his policies is doing some things with Europe.
For a few months there, it was actually flat. It didn't go anywhere, right?
Right.
And that gets even sentiment for developed market. Let's say it's mostly Europe. So we're talking about Europe. I need to say this, right? Like small caps, I can sense like, okay, there's some excitement. The fact that it's rallied, as you mentioned, the Russell 2000 just hit a new high. I mean, it's not broad excitement or anything like that. It's still, I think, excitement is on the AI side. But there are a few people, including people we respect, who are like, oh yeah, pay attention to small caps here. Nobody is saying pay attention to developed markets.
Yeah, and I guess the answer, and by the way, our guest next week, we talked about some of these concepts. You're going to love it. It was awesome. Anyway, I do like that as a contrarian at heart. I don't just blindly do the opposite of whatever I'm saying. By no means, but I've done this long enough to know that if you say something and you can back it up with some reasons why, and everybody looks at you like you're crazy, you're really on to something potentially. And that's kind of where I feel with Europe, developed international. Doesn't mean you don't want to own some emerging markets. Like you said, EM's done better in U.S. this year. That baton might be taken back next year. I think it's kind of where we are. But I wouldn't be shocked if over the next 3 years, IFA did a little bit better in the U.S. I think both are still going to be higher, I want to be clear. And yes, we are still going to own more U.S. stocks than we will IFA in all likelihood. But I wouldn't be shocked by that. I don't think so. And again, you look at the leadership, and you talked about it. Industrials, financials, materials. Again, those are very heavy things that come from developed national. Let's talk about industrials for a second, right? Uber is in there. All right. I mean, of course, Boeing's in there. And I believe you mentioned this morning, GE is the largest component, about 6%. That's like the smallest, largest. This is going to be fun to say. That's like the smallest, largest component. I think I said that correctly.
Yeah.
I think that's how you say it.
So, yes.
Because you think about tech and all these other areas and like materials and all this stuff. Like one or two big names, they account for a lot of it. I mean, like consumer discretionary. It's like half Tesla and half Amazon, right? And it is what it is. But industrials really are diversified. Industrials have a lot of things in there, from airlines to Caterpillar to Uber to all this stuff. And all of a sudden, that group is leading. That group is breaking out. There's some relative strength, up 20% on the year, like you said, probably I guess about the third best group. I love to see that. One more comment, Sonu, then chime in. If you look at R squared on all 11 sectors, that's the correlation coefficient. Long-winded way of saying the trade's about the same. There's no group that trades about the same like the market, the SP 500, than industrials. If industrials are strong, breaking out, that is a really, really positive sign overall. We are seeing that. We do like industrials. It's a cyclical play. It's that there's no recession coming next play. If you get a little upside to the economy, maybe that group continues to do well, and we're seeing it. What do you like about industrials here?
I think it's a cyclical story.
There you go.
I think it's the story of there's no recession. I think it's also a story of, I mean, not to pull like a macro thing into it, but you have to pay it. That's one thing. The way I like to think about macro and hopefully do the work I do in macro, you have to pay attention to the market. It cannot be, I see all this economic data, now let's translate it to the market. No, the market has to be part of it. There has to be some taking away from the message of the market, and the message of industrials right now is things are fine. Yeah. I mean, you could also get that message from small caps, but set that aside. Maybe there's rate cuts and things like that. But industrials, materials, the economy is fine, and there's a global, pickup in economic activity.
Yeah, your transports are part of industrials, obviously, and we've talked about this group before, but literally they peaked like 4 years ago. They went like nowhere for 4 years. Yes, tech and these large caps are way up here, but there are other areas that are just now taking that baton back. So we wrapped up earnings season. Anything you want to talk about earnings season-wise? I mean, we kind of hinted at this before.
I mean, even earnings, I mean, my big takeaway, I mean, it was good, obviously. My big takeaway is that there are fewer companies talking about tariffs. There are fewer companies talking about recession. Okay. And there's still some uncertainty and things like that, but I think maybe that's part of the reason hiring is weak. We'll talk about the labor market as well. But I think it's not just uncertainty. I think that may be an excuse. I think a lot of companies, overhired back in 2021 and 2022. Yeah. Now they're like, we don't want to hire anymore. And on the tech side, there are a lot of tech jobs being lost. I think part of it is obviously that overhiring story, and it's easy to say, this is because of AI. I think actually what's happening, it's not because AI is replacing the jobs. I think companies are like, we need to make space on the balance sheet to invest in AI. Yep. So we're not going to hire as many people, right? All that CapEx spending, like in a way, labor is CapEx. That's the biggest CapEx for most firms, right? They're probably thinking, we're going to go invest in a data center instead because we need that cash flow now. Yeah. So I think that's the story there. Yeah.
So one more thing, Drew, I did not send this to you, but as we're talking, I want to show this. So on the YouTube channel, we'll share these potential IPOs next year. So Drew, make sure I get you this chart from our friends at Yahoo. Awesome chart, I think. SpaceX, I think these are all potential IPOs. They're moving forward with them. We'll see if they happen, but this is expected, Sonu. SpaceX, 1.5 billion would be the largest IPO.
Trillion, right?
Trillion. Gee whiz. Sorry. Yeah, you're right. I think see, it's such a big number, I can't even say it. That's how big it is. You are correct,
What's a trillion here? What's a trillion there?
I don't know. It's, now I'm back to billions. Okay. OpenAI, which we've already said that word a couple times, about 500 billion. ByteDance, 480 billion. Anthropic, 183 billion. And Stripe, 107 billion. I think one thing about this bull market that I know Jim Paulson. We're big fans of Jim Paulson. Jim Paulson talked about some of these concepts. There's not a lot of excitement. I mean, there's not a lot of excitement, okay? And normally in bull markets, you see big IPOs. Companies like those names I just said that people want to invest in, and they want to have some fun. They want to make some money. IPOs are part of bull markets. You're allowed to enjoy it, everyone. You're allowed to have some fun. I think it's just, it doesn't mean the bull market's over as soon as SpaceX has the largest 1.5 trillion with a T IPO ever. I will say it gets my attention. Like, okay, well, we're getting closer, right? We're getting closer. And that's all part of this process. But from that point of view, you do wonder, are the big guys selling out to the small guys, and that's a major peak? You never know. I don't think so yet, because it's still, these are companies, I don't know officially on all of them, but a lot of these companies make money. I just mentioned there's a lot of positive things on these particular companies. They're not just slapping .com on their name like they used to 25 years ago. What's your take on, again, I assume we're going to see these IPOs. Honestly, I think we're probably going to see, unless something bad happens next year. What's your take on some of these big IPOs that are finally starting to potentially come out next year?
I think one thing you mentioned, I put a pin in that, which is that you said one thing that's symptomatic of what's happening now, bull market for 3 years plus, new record highs, 37 new highs this year. Nobody's having fun.
No, 57 last year.
57 last
whatever that comes out to, I don't know. But 37 plus 57, ask AI. It's a lot. It's a lot. Okay.
94.
Thank you, Sonu. Thank you.
There you go.
I knew it was such a high number. I don't know.
It's like I had to, say, but nobody's having fun. I think that's what it is. And even in the private markets, these companies coming out, like, I mean, 1.5 trillion is staggering. Like you just mentioned GE, right? I just looked it up.
Okay.
When the largest company within industrials is not a small sector,
right?
GE's market cap is 300 billion.
Wow.
OpenAI, what did you say? 500 billion, something like
500 billion is what this, according to Yahoo.
And what's third on the list? It's
ByteDance. Which 480 billion.
Even that's larger than GE. Like this, they make aircraft engines and lights.
My fridge, my microwave, all that stuff. Yeah.
So I mean, it gets to like the reality that there's something happening, despite all the vibe shift. It's sometimes positive, negative. There's something happening, and we have to recognize that. And that gets to, without giving too much away, and you kind of have to ride that. You have to accept that there's a new technological innovation, massive, that's happening. Now, SpaceX set that aside because they've probably been due for an IPO for a long time. And I think part of a lot of demand for Tesla is probably we need to invest in Elon somehow. Tesla is the easiest way to do it. Once if and when SpaceX goes public, I'm curious if some of the money goes towards SpaceX instead of Tesla.
Yeah.
But I think otherwise, more generally, all the other names of the company is like AI based. And it gets to the fact that there's something big happening here. And it's a question of how exposed you want to be to it.
Yeah, well said there. So, all right, good discussion. I think we'll move forward and talk about the Fed, right? The Fed did its third. I'll set it up and then turn it to you, Sonu. The Fed did its third interest rate cut this year, 0.25%, 25 basis points, as we call it. Everyone a week ago right now was talking about a hawkish cut. I mean, this was everywhere I looked, TV, media, print media, hawkish cut expected. You've got some, I'm going to say, interesting take, because you didn't really expect it to be a hawkish cut because of some different reasons. But the market, we're all, again, I love how you said, message at the market. We're not smart enough. I learned this a long time ago. I'm not smarter than the market, and the market doesn't care about my feelings. Maybe this is overvalued, maybe this is undervalued. The market is going to tell me what it wants. And the market soared on Wednesday, follow through on Thursday, after this Fed meeting that, again, was not nearly as hawkish as they thought it would be. Take it away, Sonu. What did you find? And after a couple of days to even think about it, process it more, what did the Fed really have to say last week?
I think I get into this too because I'm so focused on what did this Fed member say? What is Powell going to say in his press conference? I think that's where a lot of this, it's going to be hawkish. He's going, even if they cut, is he going to pull that back with his statements? I'm like, sometimes you just have to focus on the big picture.
Okay.
What's the big picture? They've cut 75 basis points over the last 3 months.
Okay.
They've cut 175 basis points over the last 15 months. Meanwhile, core PCE inflation, which is supposedly what they look at and target, when they first started cutting in September 2024, 15 months ago, it was 2.8% year over year.
Okay.
Right now, it's 2.8% year over year. We've made no progress.
Yeah.
Yes, the unemployment rate has gone up a little bit. It's gone from 4.2% to 4.4%. Yes, the hiring is eased and it's historically low. But hiring's weakened. But still, the employment population ratio, Ryan, you and I have talked about that before. 25 to 54-year-olds. How many people are employed as a percentage of the population? That's at 80.7%. That's higher than at any point between 2001 and 2019. I don't mean to say the labor market is gangbusters or very strong. It is certainly, there's weakness out there. But given this perspective, the Fed's cut 75 basis points, 175 basis points over the last 15 months, while core inflation remains elevated. How can you read that as anything but dovish? I don't know. I like all this hawkish cut. I'm like, yeah, come on, guys. I mean, at the start of the year, we were bullish. One of the things is one of the tailwind is don't fight the Fed.
Yep.
We think the Fed is going to cut 2 to 3 times, and now they have cut 3 times. So I'd like to, for us to take a little bit of credit. We've got the Fed right for the last 3 years running.
Yeah.
But that's bullish. I don't care what they say. But we could talk about what they said, actually, too.
Well, let me jump in there. We'll talk about what they said. There's something called the dot plots, which you'll talk about, but there's 19 different members, and look at the median dot plot. We're looking for one cut next year in 2026, but there's something called Fed Funds Futures, the market's bet. It's a little bit, between 2 and 2.5, somewhere around there, right? Or a little over 2, a little over 2.
Actually, maybe I'll put this chart up, and then we'll come back to the dot plot.
Okay.
What it shows, without getting too much into what exactly, is on the chart, it basically shows on the dark blue line what markets expect for Fed funds policy to be over the next several years. And then it also shows what the Fed members expect policy rates to be over the next several years. So the near term, next year, markets expect 2 to 2.5, something like that, 2.5 cuts or so. The Fed's expecting 1 cut. Fair enough. But that could change, right? Because we'll talk about the Fed, how there's a lot of dissent and, different camps wanting different things on the Fed. But in future years, what the Fed is expecting is that, inflation will fall back to target, and then we'll be able to stay at, quote unquote, the neutral rate of about 3% till the end of Kingdom Come, right? But markets are like, no. We think, yes, next year and 2 years from now, you probably ignore inflation and you'll cut rates. But we think inflation is going to be a little bit of a problem, so you guys are going to raise rates from 2028 onwards. In fact, by 2030, markets expect the Fed funds rate to be higher than where it is today. And that tells me that markets think, and I say us too, over the last 2 years, we've written our secular outlook is that we are in a period of inflationary growth. And when you have inflationary growth, yes, for the time being, the Fed's ignoring it, and we'll talk about why that's good for gold. But in future years, they won't be able to, and they need to pick rates up, keep rates elevated, on the far side of everything that happens in 2026 and 2027.
So some good stuff there. There are 19 Fed members. Remember, there are 12 voting Fed members. Sonu, you pointed out, if you look at those dot plots, 8 of the 19 are looking for 2 cuts or more next year, right? So there are some vocal people that might say this, vocal might say that, but the majority, 8 out of 19, are still looking for probably a little bit more dovish Fed next year. Is that where Powell, you think, sits? Where does he sit in this whole thing?
I think so. We'll put the dot plot up through the Fed projections for Fed funds rate. By the way, the dot plot actually has dots. I don't know about you, Ryan. I always find it hard to count.
It's
like, is it like 8 dots? Is it 9? Is it 10? Or is it 11? This is ridiculous. So I've actually put numbers just for my own sanity, right? So, now I think there are 3 camps.
You know what? Time out. We should create something called the Sonu plot. And it's simply the dot plots, but it's so you can actually read it. It'll have the numbers on it. I think you might have something there, Sonu. Yeah.
Like the dot plot has always been like, I can't see this. I need to put this in numbers. But anyway, going to 2026, I think there are 3 camps within the Fed. One is a hawkish camp. And you mentioned there are 19 members. 7 out of 19, who are hawkish, want no cuts next year.
Okay.
4 out of 19 want 1 cut, or they project 1 cut, right? And I think Powell is likely in this camp. He probably is like, maybe 1 cut next year. But 8 out of 19, by 8 out of 19 is a majority at this point. 7, 4, and then 8. 8 out of 19 want 2 or more cuts.
Interesting.
Including there's one member who wants 100 basis points of cut next year, and No prizes for guessing who this
I
one is.
wonder.
No.
Who.
There's one
Wonder
more
who.
person who wants 150 basis points of cuts next year.
Oh, okay. Well, how about him? Okay.
I guess it's Stephen Moran, but
Yes.
yeah, no, I think it's split, but the majority want cuts. 8 plus 4, 12 out of 19. Clear majority want cuts next year. I think we're getting cuts next year.
Mm-hmm.
Even though there's dissent, I think a lot is made of the fact that there are dissents. In fact, out of 12 votes, we had 3 dissents in December for the December cut. 2 of them dissented because they didn't want a rate cut. And one, Stephen Moran, wanted a 50 basis point cut. I mean, he's been saying that for the last 2 months, right? The 3 dissents, it's notable. Yes, the last time we had this was September 2019, also under a Powell Fed. 3 members back then said, oh, we don't want to cut rates by 25 basis points, right? It's fine. It's not a big deal. Would you rather have a unanimous decision? Sure. But if you don't, you still got a rate cut. That's what matters.
So what's unique about it? I mean, we're talking 12, we're talking 19, whatever number you want. You put people in a room and you say, do you agree on this or not? I mean, think about the world we live in now. I mean, it's not happening, right? So I think, and you talked about this, I love this concept that one of the gifts Powell will give, is maybe a Fed that doesn't just everyone just always agree. I don't think that's good. I don't think they should. And I think he understands with the pressure from the president and the next Fed chairperson, maybe trying to make their job a little bit easier potentially by giving us a Fed that doesn't always agree on things. I believe it's 5 times, going back to what, 93 that we've seen 3 dissents, kind of like we just saw. So again, that's not normal, but maybe it's I hate to say new normal. Remember they used to say new normal, whatever new normal meant. I think new normal meant like equities are gaining like 2 or 3% a year for like decades. They told us that 15 years ago. That didn't work out. But anyway, a more of a new normal where you're going to have more dissents. And I think that's maybe a step in the right direction. Well, put it this way. How'd the market take it, right? The market, transports up 2.8% last Wednesday. The Dow had its best Fed day since December 23, up 1.1%. Small caps up 1.3%. S&P up 70 basis points. The market took it in stride. Now, let's talk about Powell's Q&A for a second, because that's dot plots. That's the what do you call it? Statement, all that stuff. I watched it for the second time in a row, and usually I don't. I just let you do this stuff. But I watched it, and they were better. Remember I complained 6 weeks ago at how every time someone took the mic, they immediately went, Mr. Powell. I said, do not clear your throat directly into the mic when the whole world's listening. Clear your throat. And you know what? I think they listened to me, Sonu, because I didn't hear one person. So maybe they listened to
Ryan
me.
Detrick,
do not clear your throat when they hand you the mic immediately. And there are a couple zingers. I mean, Powell, he has to be proper and but he threw a couple zingers out there. He's funny. I got to give him credit. I'm looking forward to the day, whether it's in May or he might stick around, but whenever he officially leaves the government and works for PIMCO like they all do wherever you go work.
Or he writes his book, right? And he's on a book tour.
Maybe we get him on this podcast. That'd be great. He's funny. I think he would be really to just kind of get him a little more out of Fed mode, but just funny. He's very quick-witted is what I'm getting at. So I like that. So what did you think during the Q&A, though? Because it sure seemed like the market loved what he said, and we had that follow-through on Thursday.
And this gets to why it was dovish, even more so than I thought. It was the cut is always dovish. Look, the Fed's worried about the labor market. The rationale is, the labor market risks have increased. And of course, there are upside inflation risks, but now both are in balance. And since rates were on the tighter side, they need to, since both risks to their mandate are sort of in balance, they need to bring the policy rate closer to neutral as well. That is the argument, right? Powell, which is interesting. So he said since April through September, that's probably, that's a period in which we have payroll data. Job growth has averaged about 20,000 a month. He thinks the actual number, Ryan, is negative 20,000. It's 40,000 below that.
Wow.
Right. Okay. And that's his rationale for, if you think that's the case, of course you should be cutting. What else would you do? Because now he says some of this is lower supply due to lower immigration. But when job growth is negative, he said they want to make sure policy isn't pushing it further down. And they're looking past elevated inflation for now. But look, they're going to be in wait and see mode after this, right? Jan rate cut odds are at 24, 25%, something like that. Look, I think where January 9th, we get the December payroll report. If the unemployment rate goes to 4.6%, I think Jan rate cut odds go up to 80%.
Got it.
if you
Where are
at
they now? Like 25 right now, ballpark?
24, yeah,
24?
somewhere
Yeah.
20-25%.
Okay.
I think that's, that's how Powell's looking at it. And what was actually the biggest shift in the statement of economic projections, the dot plot, was more than the dots itself, because the dots said, if you could even eyeball it and understand what the hell where the dots were, dots are kind of all over the place, right? You have different camps in the Fed, as I mentioned, but GDP growth expectations. 2025, they bumped that up 1.6 to 1.7%. Fine, that's just noise, right? 2026, Ryan, they bumped it up from 1.8% to 2.3%. Wow. That is the highest they have ever projected for 2026 real GDP growth, going all the way back to December 2023. This is the most optimistic they have been for 2026 real GDP growth since then, in 2 years, right? So that's a big deal. And just think of it. They've upgraded GDP growth. Meanwhile, they're cutting rates and they're projecting more cuts. How is that not dovish? That's dovish. And then on top of that, they're projecting lower inflation. This is where you kind of get to the phase of they're kind of having the cake and eating it too, because now the icing on the cake is they don't think the unemployment rate is going to go up further. They think it's going to be at 4.5%, 2025. They think it's going to go down to 4.4% in 2026. That's also dovish, right? Because, I think most people are puzzled when they look at it. They were like, wait a minute, how can you upgrade GDP growth with lower inflation and lower unemployment? The Fed's making two bets here. One is they've lowered rates enough to prevent further increases in the unemployment rate. Okay. And two, they think if you're going to get faster economic growth in 2026, that's going to boost the job market. That's going to lower the unemployment rate. So the Fed is basically betting on productivity growth. Yeah. You and I have talked about this in the past over the last few years. With productivity growth, you can have faster economic growth. You can have lower inflation. You can have a strong labor market. And that allows the Fed to pull the rates lower. You can argue what's happening in this year is a little contrary to that, because we just talked about the labor market is weak. Usually, like, productivity is hard to measure, right? Because, quarter over quarter, you see, it's a big jump, or it's a big, there was productivity growth number, but that's all quarterly noise, right? And productivity growth is calculated it's derived out of two other measures, right? Output, which is GDP growth, equivalent, and hours worked. Okay. Whereas, maybe a better way to look at it is like, is the labor market strong and is inflation going down? We have reasonably good data for that. You can argue whether, inflation can be calculated a better way, whatever, right? It doesn't matter. If you have a strong labor market with lower inflation, I don't need to see productivity growth data. I know productivity growth is strong. But now we have, inflationary pressure. We have not so great labor market. I'm not saying they're wrong completely in betting on inflation, on productivity growth, but I'll put it this way. Our bet is more, you'll see growth maybe reaccelerating in 2026, but though we don't think inflation is going to go back to 2%.
Well, we titled last week's podcast "Reacceleration," right? We talked about the reacceleration theme, and it doesn't mean just growth or the bull market. Well, it probably does, but maybe inflation reaccelerate. You can see some reacceleration across the board. Good stuff. I mean, the final thing I want to point out, Drew, we can put this chart up. It's the one I shared. When the Fed cuts within 2% of an all-time high, 22 times we found a time where the Fed cut within 2% of all-time high on the S&P 500. If the S&P is right at an all-time high. 1 year later, Sonu, S&P's higher 22 times, up over 14% average. Now, they've done it 3 times just this year. I call it one of those "it is what it is" stats. No, you don't blindly invest in this, but there is that old saying, don't fight the Fed. And they just cut near all-time highs. History would say that's more of a positive than a negative. And as we start talking about 2026 and how we see the world, we have a dovish Fed. Historically, cuts near all-time highs are a pretty positive thing. So that's just something to absolutely consider when you're formulating your views on 2026. Anything else you want to talk about on the Fed before we move forward?
Do you think we'll ever stop talking about the Fed? Like, will there be like 6-7 weeks in a row where the Fed kind of takes a backseat? I don't know. I next year, especially with, now we're going to be in that, what do you call it? We're going to see this game being played about who's going to be Fed chair.
Right.
Well, and that's the type of game I think the president sort of is so comfortable with, and he loves to probably see it, and he loves to stoke it as well.
Well, I guess my take is be careful what we wish for, because if we're not talking about the Fed for 6 weeks, maybe we're talking about something even worse. I don't know.
That's true. That's a good point.
But no, you're right. I mean, I started this industry what year is it? About 25 years ago, approximately. And Yeah, when I first started, we didn't really talk about, maybe because I work with you now. I don't know. You love talking about the Fed, but I just people didn't talk about the Fed this much. It was like you looked at
Oh
Greenspan
yeah,
and you
yeah,
looked how thick his briefcase was, and you said, okay, well, they're cutting or they're not. Like that's all. That was the
yeah,
extent
yeah,
of
yeah.
I'm sure there's a little more in detail than that, but you're right. I mean, clearly Fed policy is so important. But I guess to put a bow on it, they said inflation might not be as high. It's going to improve a little bit. They said the economy is going to be stronger, and there's still more rate cuts coming. If that's all you know, that's probably net positive for U.S. based investors
Yep.
or investors in general. And again, that's kind of how we still see things playing out. So you're flying to India by yourself. How do you go? You go from Chicago to where to where to where? How's it
Chicago
work?
to Doha, and then Doha to Bangalore. Yeah, which is
Now,
where some family is, and I'm hitting 3 cities in 6 days.
man,
It's an 8-day trip. 2 days
oh
are going to
boy,
be on a plane.
yep,
So, or 2
okay,
planes or 4 planes, however you count that, the return
yep,
trip as well. But yeah, no,
okay,
the family is going to be in Florida by the time I come
mm-hmm.
back. So I get back on the 24th. I have to change airports, get to Midway from O'Hare. I have like 3.5 hours to do it.
Oh my goodness.
Like something for us to talk about. We'll find out if I actually
Well,
make it. Otherwise, I'll be spending Christmas Eve alone at home.
well, come over to Cincinnati. We'll have fun.
There you go.
You get stuck there. It's plane, trains, and automobiles in a way. Well, hopefully that all goes smoothly.
Yeah.
Have you started Landman yet? You're gonna download a bunch of Landmans?
Oh no,
What are
I'm
you thinking
downloading
here?
it. Yes, yes.
Yeah.
I'm like, I need to binge.
Mm-hmm.
Right, I
Yep.
can't wait 1 week for that. I'm done with that. Like I can't wait 1 week for an episode. That's
Remember when
ridiculous.
Netflix started that? It was like, that's so weird. That's so
Yeah.
weird. They do it all at once. Now it's like, now what you just said, I can't wait. So I have been watching Landman every Sunday when it comes out. And it seemed the last couple were a little slow, but I'd say this one got good again. Sam
Okay.
Elliott's getting way more involved. His father, I'm not giving any away. If you see the commercial, Sam Elliott's his dad. He starts living with them, and you just know there's going to be some fun with that. So I'm yeah,
You know what I
I
am
love that
enjoying,
show.
and what I recommend if you haven't seen it already
Mm-hmm.
is The House of Guinness
Huh.
on Netflix.
I haven't seen that
So
one.
I
Okay.
mean, it's Guinness. It's about Guinness too. So it's interesting, and it starts off a little slow, but it picks up. It's
Okay.
yeah, it's definitely interesting. I am a Guinness man myself. So
There you go. Okay,
on
well,
draft,
good.
on draft.
On
Yes.
draft. Well, that makes sense. That makes sense.
Yes.
All right, cool. So let's kind of wrap things up. There are 2 more things we want to talk about: gold and the labor market. Maybe let's go gold first. I don't know why, just because. The time we're doing this, gold is hitting all-time highs. Gold had that really, I'm gonna say, scary is a probably strong way to put it, but gold is up ballpark 60% for the year. Then it had almost a 10 to 15% really. Oh, those your kids yelling at each other? I think I hear it, Sonu. Are they yelling at each other? I don't know if I heard that or not.
Something like that.
Whatever.
I think
Whatever.
I've gotten used to blocking it out.
Yeah, they're killing each other up there. They'll be fine. They'll be fine. They'll be fine. Anyway, but we had a scary pullback, and now just as quickly, and that was because you'll dive into this, but we had some hawkish Fed talk. We talked on this very podcast about that. But if all you looked at was gold, you could say,
Yeah.
the Fed was dovish last week because
Yep.
that's what gold's doing. So what's up with gold here?
I think that's it. The gold's message of the market is that the Fed, you have a dovish Fed in the face of elevated inflation. Or I'll put it this way. It's dovish because the Fed is cutting rates in the face of elevated inflation. Going back to the top of the Fed discussion, they've cut 175 basis points over the last 15 months. Inflation's stuck at 2.8%. Now, you can quibble about why and how the tariffs, whatever. Set that aside. It is what it is. 2.8%. They've cut 175 basis points. Gold is like, yeah, we like it. Gold's going up. Gold is up 63% year to date. Since the low on November 4th, the recent low, I should say, it's up close to 10%. Since the Fed meeting, since that afternoon of when Powell started speaking, gold is up about 3%. And in fact, it's more today. We're recording this on December 15th. Right. So I think it's up like 3.5%, 4% since then. So yeah, I think it gets to the fact that it's that whole, to quote our friend Warren Price, the debasement trade. What does that mean? The Fed's cutting, but inflation's elevated. Doesn't mean like we're not inflationistas. We don't think inflation's going to 4.5%, 5%, anything like that. But it's not going to 2% anytime soon.
Right.
Just look at metals and mining ETFs, or like the metal sector, the commodities sector. I mean, except for oil, everything else is going up. That's not, I'm not saying inflation's going to surge because of that, but that's an environment where inflation's on the higher side.
No, well said there. I mean, we've silver breaking out well over $60 to the all-time highs. Copper's flirting with all-time highs. Gold's obviously right there as well. A lot of the grains and different areas of commodities we mentioned. I guess it was last week, right? That Bloomberg Commodity Index, like breaking out after multi-years of kind of consolidating. It's breaking out. Yes, crude oil. I guess West Texas has been I don't know if disappointing is the right word, because hey, everybody kind of likes lower oil, but the reality is most commodities in general have done well. I don't think we'd be shocked at all if next year crude oil had a decent year, following the lead, if you will, on some of these other commodities. So, all right. Well, anything else on gold, or you want to talk about the labor market and wrap things up?
I can always talk about gold. I'm going to India, so maybe.
It's true.
No, we can move on.
The labor market, like we said, the Fed during the Q&A, Powell kind of opened the door that the labor market's a little weak. That's why we can cut. The big question we've all had is inflation's going a little bit higher, but the labor market's weak. What should the Fed do? The big worry is the Fed cuts too much, like the 175 basis points like they have, and then you have inflation comes soaring back, right? If inflation comes soaring back, what does that mean? Well, we just saw back in 22 and 23, people really don't like higher inflation. They can take a bear market. They can take a recession. They do not like, and it's midterm year. It's all politics, not all politics, a lot of politics here. So that's kind of where we are with things, Sonu. But you pointed out that labor market, there's some pros, there's some cons. As usual, truth is in the middle. Let's talk about that JOLTS data. What'd you find? And that's job openings, labor turnover survey. What'd you find when you looked at that recent data?
So openings went up, but I set aside openings because it's so noisy. Okay. How do they measure openings? Set that aside. But I think they're high quality data, and JOLTS is high quality data. This is from October. So it's the first piece of labor market data from October that we've gotten so far. Hires are down. The hiring rate, which is hires as a percentage of the workforce, that went down to 3.2%. That is the lowest this cycle since COVID. Yeah. It's the weakest pace of gross hiring since 2012.
Wow.
Right now, we've already been in an environment. We knew that's not new news. Like, you're probably not that surprised. Like, okay, hiring's weak. You've been telling me that story for 12 months now. Right?
True.
But quits, I feel like this is a little bit of an underrated indicator, labor market indicator. I'm not saying it's my go-to indicator, but it tells you something. Quits is, you've gone through this, Ryan. Like, the grass is greener on the other side. I'm going to quit my job and maybe go work for somebody else for a higher pay. When does that happen? If the job market is strong. If the job market's weak, quits will fall. It's not easy to leave a job and find another one. So the quit rate fell to 1.8%. That is the lowest this cycle. It kind of breaks the range we've been in over the last 2 years. That by itself tells me, what, the labor market isn't doing great shakes, right?
Yeah, that was the lowest. 1.8 is the lowest. It's May of 2020. Let's just remember for a second what May. And we were at 2, so we skipped 1.9. So it was a pretty good sized drop in the quits. And like you said, layoffs are 1.1%.
It went from 1.1, the layoff rate, which is layoffs as a percentage of the workforce, that went up from 1.1 to 1.2. It's still that's still relatively low. 2018 to 2019, we are going at 1.2 to 1.3%. So layoffs are, by the way, clocked in at 1.85 million just in October. So when you see Challenger data, 60,000 layoffs, 20,000 layoffs at that company, 3,000 layoffs at some other company, keep in mind in the U.S. economy, there are about 1.8 to 1.9 million layoffs per month, right? And by the way, that is actually on the lower side because that's the range we saw before the pandemic, and now the workforce
labor market's bigger.
Yeah. So initial claims still don't, point to a big increase in layoffs, but look, the big picture is labor market risks are high.
And we've said that for several months now, and that's why we've been in the camp the Fed probably should be cutting. Yes, there are pockets of inflation nobody likes to see, services and goods, but the truth is it's a delicate situation, and they should probably keep cutting.
And that's why we have gold.
That's right. That's why I have gold and diversify portfolio and own some bonds and own some cash and own some this, own some that. I don't know. I'm trying to look here. I don't know if there's anything else I really wanted to touch on, Sonu.
I'll just pick up on this one thing. The other labor market data they got was the employment cost index.
Oh, yeah.
And if you have this chart, you can put this wage growth excluding incentives continues to ease. And so you look at the employment cost index, this is the gold standard of wage growth measures, right? And that's because they adjust for the fact that in some industries, wages are higher. In other industries, wages are lower. So they don't just take a broad average, because what if there are more layoffs in the, lower wage industries? The average goes up. right? That's what happens in recession. So you want to be careful about that. The employment cost index adjusts for all of that. The Fed likes to take out incentives and benefits because those create volatility depending on how companies are doing. They may not get benefits and things like that, right? Or bonuses, etc. But that's running at 3.5% now. It's come down. It was running at close to 4% a year ago. It's running at 3.5% year over year. But Ryan, that's still not quite weak. It's still above the pre-pandemic pace of 2.7%, right? So that kind of tells me, you know what? The labor market is not collapsing here. It's weak in a lot of areas, but there's more than just weak demand. I think there is a component of weak demand. Maybe it's uncertainty. Companies are like, we don't want to hire. And maybe it's partly because they overhired, going back to what I talked about a little while ago, 2021, 2022. Now they're like, you know what, let's just wait till these clouds of uncertainty are done with. Maybe global demand picks up. Maybe the economy does pick up next year, and then maybe hiring gets better, right? So, yeah, I one thing I've been thinking about, last thing, without going on about this, but is I talk about productivity growth. With productivity growth, what do you get? You get low inflation and a strong labor market. In fact, I said, if you do have a good labor market with low inflation, that means productivity growth is strong. You don't need to wait for the productivity growth numbers to tell you that. But then you see, like, I'm sure you get the question too, and you meet clients like, oh, will AI get rid of all the jobs?
Oh, yeah.
Right? Will unemployment go up? But think about it this way, like, if everyone's laid off, who's going to spend? How are companies going to earn revenue and income to invest in CapEx and AI, right? So that's the way I think about it. Now, there is one way in which it could potentially happen. Can we get a strong productivity growth environment with a weak labor market? That gets to, if companies take all the productivity growth and turn that into margin expansion, that's good for the stock market. But if they do that, right, then real wage growth doesn't go up. Now, historically, they haven't done that. In fact, in 2023, 2024, productivity growth was running at 2.6%. 1996 to 2004, productivity growth was running above 3%, right? A good 60, 70% of that was translated into real wage growth. Companies took about 30, 40% to expand margins, right? But if firms eat up all the productivity growth by expanding margins, you don't get real wage growth. So you could have a situation in which, productivity growth is weak, and productivity growth is strong, like the Fed is betting on, but the labor market is weak, right? I think that's unlikely to happen over a long period of time, because if firms are expanding margins, yes, that's good for the stock market. But what do you have? How are they expanding margins? By increasing prices. And that's why, real wages are going down. Nominal wages are getting eaten up by inflation, right? That goes only for so long. After some time, companies are like, you know what? We can't keep increasing prices anymore, like FIFA for the World Cup next year, which I'm still pissed about.
Oh, boy.
but at some point, demand will weaken, right? That can't go on for a long time. So I don't quite buy the whole story about AI leading to lower unemployment, right? If that happens, you'll be in a recession, but that's a whole other story. So,
well, that is definitely stuff we can get into over the coming months of 2026. Again, thank you to all listeners. If you like this podcast, we'd love if you could subscribe, hit the like button, give us a follow, give us a review, make a comment on the YouTube channel. All those things go a long way with the algorithms to help this podcast. Well, Sonu, safe travels to you. Enjoy. Is your mom going to make your favorite dish? Did you tell her?
Yeah. And that's just before. But I'm coming back to spend Christmas with my family, like the family here, their wife and kids, and in-laws down in Naples. But hopefully my kids will still be in one piece. Like, I have to go upstairs and see if they're one piece now.
You better. It's quiet all of a sudden. I think. I don't know. I heard some yelling there. Yeah, I don't know.
Oh, yeah, there's a lot of yelling and screaming. Like two kids in school, out of school, and yeah.
And especially if one's kind of sick, the other's messing with them. That not very happy. Well,
both of them are sick. My daughter gets out, like, she sees that my son's sick, and she's like, "Oh, he gets to stay home." So I'm not convinced that she's sick. Anyway, I took both of them to the doctor. Come back, she's totally fine. He's got strep. Right, so he's on antibiotics now, and she's like, then she asked me, like, she's got Girl Scouts this evening. She's like, "Oh, can I go to school?" And I'm like, "No. You just skip school. You're not, going for the fun stuff here."
Right.
But anyway,
well, yeah, that's funny.
The life of being a parent, you've been through that.
Oh yeah, I mean it's constant. It doesn't stop. It's just it's something. But anyway, all right. Well, we're gonna put a bow on all of this. Everybody, thank you so much for listening again to episode 166 of Carson's Facts versus Feelings. The Fed comes bearing gifts. You know what? One more. Sorry.
Okay.
YouTube channel. I didn't share this one yet. Historically, it's December 15th. That's when the S&P bottoms for the month, and you tend to have that rally. We're recording this December 15th, so we'll see. The second half of the month is usually strong in December. We're optimistic that we have 37 all-time highs. We're probably going to have a few more before this year is all said and done. Just wanted to make sure we share that chart. Everyone, thank you. You're going to love next week's podcast. Be on the lookout for it with a very special guest from Boston. It was an amazing discussion, and thank you. We love doing these podcasts. We'll just do 52 of them a year. We'll keep doing them every single week and keep listening to them. Sonu, safe travels, and everybody else, enjoy the holiday season. Stay warm out there, and we'll see you next week with a very, very special guest. Take care.
Information provided on Facts versus Feelings with Sonu Varghese and Ryan Detrick are for general information only and are not intended to provide specific advice or recommendations for any individual. The statements and opinions of show guests may not be reflective of CWM LLC or its affiliates. Past performance is no guarantee of future results. All indices are unmanaged and may not be invested in directly. Investing involves risk, including possible loss of principal. No strategy assures success or protects against loss. To determine what may be appropriate for you, consult with your attorney, accountant, financial or tax advisor prior to investing. Guests on Facts versus Feelings are not affiliated with CWM LLC.